Welcome to the Capital Discussions OptionVue Education Seminar for the month. I'm Tom Nonamaker with our guest, Steve Lentz. Hi, Steve. Nice to have you here.
Hey, great. Thanks a lot for having me, Tom. Great to be here.
Before we get started, quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I will stop sharing my screen and give you the presenter role, Steve.
All right. No, thanks a lot. Here, then I go to share my screen.
And I see coming up, there it is.
Trade Finder Free-for-All. Perfect. There we go. Well, thanks a lot, Tom. It's great to be here. I'm Steve Lentz with Discover Options, which is the educational arm of OptionVue. OptionVue's been in business since 1983, primarily focused on the highest-end analytics for options trading, primarily in software. Around 10 years ago, we rolled out Discover Options as the educational arm. We have an advisory now regarding for the VXX trading system. And what I want to focus on today is a part of the OptionVue program that I think kind of gets overlooked, and just kind of let's just examine it a little bit. It's Trade Finder, which is within the OptionVue software itself. And here, let me see if I can go to there's F5. Let me see if I can do that. Click F5. That's not letting me do it.
What are you trying to do?
I'm trying to go to a full screen. But within WebEx.
Just click on Slideshow, and then you
Slideshow.
Should do it from beginning.
From beginning. Well, I am on the first slide. Oh, there we go. Huh.
There it is.
All right.
That's it.
Perfect. And then if I can just click that one and that one. Okay. Perfect. Here we go.
Keys too, left and right.
Yep. Got it. So before we go to Trade Finder, though, there's two concepts I want to explain because it's just critical to understanding the results from Trade Finder. And that is expected return and the standard deviation. And so when you go to a graphic analysis within OptionVue, you'll see down in the bottom left, it says ER down there. That's expected return. And when you're using the current bell curve, all right, and really with all expected return calculations, it's taking 11 evenly dispersed investment outcomes. So we take, in this case, we have the bell curve, and we take 11 outcomes over the width of the bell curve. And you can kind of see in this particular case, we have, one of the offset put broken wings with an added call. Is that an added call thrown in? Yeah, an added call thrown in, lifting it up a little bit to make that T+0 line delta neutral. And so, but I'm going out, in this case, to the expiration at 77 days out. And so then we're looking across the width of the bell curve, and we have those 11 outcomes across the expiration line. And so if you take the return levels of each of those 11, and what it is, in this case with the bell curve, it's the sum of those 11 evenly dispersed investment outcomes after weighing each outcome by its probability of occurring. So clearly, those on the very left out on the wings and way out on the right on the various wings, those have a much lower probability of occurring than the ones in the middle. And so the ones in the middle will get weighed more. You can kind of see over in the bottom left, the expected return is positive, in this case at 22.14. Now, the number underneath it, the plus or minus, okay, that is the standard deviation of these outcomes. It's the square root of the sum of the squares of the differences between each outcome and the expected return. Just a standard definition of what standard deviation is. So ideally, you want to have a high expected return and a lower standard deviation. Standard deviation is kind of a reflection of the risk relative to the possible return. Okay. Now, now in Trade Finder, and what we're going to do, and I'm just going to ask you guys to please and is to start putting together. I hope you came to this session with an asset in mind and a target in mind. Okay. I forgot to throw that out there at the beginning, and that this is kind of for you guys. If you have an asset, a stock, an index, an ETF. We'll go into OptionVue, we'll bring the prices in, we'll go to Trade Finder, and I want to take your target for where you think it's going to go, and we're going to let Trade Finder locate the best trade to best exploit your target. Okay? And it could be a bell curve. You could shift the bell curve, but think about that, and we're going to get to that in just a little bit. But when you have a customized target, and like in this case, I said, okay, this target is set 39 days into the future, and I made it basically, from 2250 up to 2460. Okay, that I thought that in 39 days this thing would be between those prices. And then if I go out to 39 days, you could see the expected return is 12%. And we can express it in terms of the dollar amount or the yield. And then there's the standard deviation there. But you could see these 11 outcomes here. And in this case, the expected return with a custom target, we're just going to take an average of those evenly dispersed investment outcomes. We don't do the bell curve approach, because now with a custom approach, you can have your target be one data point as of a certain date in the future. You can have a spread of prices to occur over a spread of dates. Okay. And so you can really go to town on your targeting, and targeting is everything to Trade Finder. So as we'll see when we get to specific examples. Is that it? Yeah. Okay. So with that in mind, I'm now going to back out of this and go to my OptionVue program, and I'm just going to have this in back trader mode as of about a half an hour ago, with today's data. And I'm going to let, can you guys now I'm sharing my screen. Can I see chat somehow? There's chat. Okay, so I'm looking at a thing from John. What is happening with the forest fires? And apparently there's eucalyptus trees burning. In Portugal, is it? I guess. And so if you guys have stocks or targets, go ahead and chime in here, and I'll dial it up in OptionVue, and we'll go to town here. Okay? And if you want me to shift I could shift over to real time if that's desired as well. So I was just going to say eucalyptus trees. I grew up on a golf course in Southern California. We had eucalyptus trees lining every fairway.
Oh,
my
nice.
memories of eucalyptus trees are my golf ball hitting the trees and the sound of the ricocheting as it came off the trees. Stock symbol COH, $45 target. All right, so let me dial up COH first. All right, come on now. COH. Okay, this thing trades around a little over $2 million in options. And I'm bringing up, the weeklies going way out. You think it's going to go to 45. Okay. So, Stephen, I need to know, let me just take this. Let's go to Trade Finder now. I'm going to click on Trade Finder. We come over here, and Trade Finder has these little tabs here. You see this? So what I'm first going to do is in the matrix, I'm going to go to the model, and I'm going to make sure, I'll tell you what, I'm going to use no slippage. I have $1 per option commission set. And I have to make a decision. I'm going to leave combined call put skews off for now. Okay, this will affect the outcome quite a bit. This is the default setting. When we go to the indexes using some complex strategies, often we'll go ahead and check that, but I'll leave that unchecked for now. And let's go over here. And so, Stephen, I need to know when you think it's going to hit 45, in the future, okay? And so we'll have a real simple example here. When do you think it's going to hit 45? End of the year, okay? Well, that's about 4 months from now. Let's just say 4 months, 30 days, let's see, 120 days out. So it's going to, so Trade Finder is now going to have to go out past all these front weeklies and monthlies and only contemplate the Jan and Febs. Okay? Because if I put a projection out that far, okay, well, November doesn't go out far enough for that kind of projection. So in this case, it's only going to include Jan and Feb. But that's okay because this is a great illustration. So with that said, I'm going to click Trade Finder, not T-Log, Trade Finder. Okay, assets. I'm going to bring in Coach, targets. Okay, good. You think it's going to hit a certain price as of a certain date. So I'm going to go to price, and I'm going to say it's going to hit 45 as of, in the future, let's just say, I'm going to say 12, let's go 12/31/17. All right? Now then, we go to strategies. What strategies do we want it to contemplate here? Now, I could click Select All Covered. It's going to include all those. And given that there's only 2 months of options to consider, let's go ahead and do that. Okay, I'm going to select All Covered Approaches. I'm going to go to Goals. And let's say that you're going to spend, let's just say $2,000 on this trade. No slippage, $1 commissions. I'm going to remove these. Let's say that we're going to, for $2,000, we want to know the profit and loss in dollars. Filters. Right now, I'm not going to use any filters, only because, except down here, I want it to only contemplate options that have some open interest. And but you can see there's a tremendous number of filters that you can go crazy with and to whittle down the results. But I'm going to leave these out for now just to show you how this goes. Except for if it tells me to sell some options, I want it to, I don't want to sell an option under 50 cents if it has a spread out there. Filters 2, we can, in terms of some of the selling out of the money options, we can tell it certain standard deviations, okay, where to go. With that done, let's go, and I'm going to base this on these trades will come in the order of highest expected return. So here we go. It's contemplating all those covered strategies to make have the highest expected return as of December 31st, 2017. So here we go. It found a Feb butterfly. This is not a surprise. Now remember, there's no slippage. Look at this, 2,000 contracts, really? Because if I hit Analyze now, it's showing that and it's here's the results. Here's the target right up here, okay? And it's taking us out to T plus 132. But the expected return, okay, as of that date in the future is going to be $10,000. $10,000. Now, probability of profit, that's really, based upon the target that you set. So, you didn't have a width of a target. So, on these where you have a specific price as of a certain date, I have noticed that if you tell Trade Finder it's going to hit this price as of that date, you know what it's going to do? It's going to find a butterfly that's going to be set right on that price. And ideally, you would have chosen a price that is at an expiration date, because then you get the tip of that butterfly way up there. Does that make sense? Okay? So that's what it's going to show you. And it really, and you're going, well, that's just not realistic, I mean, well, look, it's garbage in, garbage out. It's a computer. It does what it only tells you. It only will spit out the data that you give it. Now, let's go ahead and throw in some slippage here. Okay? Let's go to Matrix and watch what happens. If we add in a little bit of slippage here, even small, let's just see what happens when we run Trade Finder again. 2,000, 4,000. So if it throws in a little slippage, let's just see if it comes up with the same trade. If the spreads are really tight, then it should be very similar. And look at this. A completely different set of results now when it starts applying slippage, because it's just tough to get some of the prices. And if you throw in slippage, you're going to have it a little bit, the results will be far different. Here we have a debit spread. So let's now click on this, hit Analyze, and there you go. It's now showing us the expected return is $1,818 out of 2,000. So that's almost 100%. I could go to yield. No, wait a minute. No. Target. There we go. Expected return, 91%, given our target here of $45 at that time in the future, T plus 132. Okay, so it's wise to throw in slippage. Stephen, did you want to maybe alter the target a little bit? We could change the. Let's go and alter the target a squeege. Okay, let's say that you thought it was going to be. Okay, a low price of say 43. A high price of, say, 47, all right? And it can have a date range. Say you thought it was going to be anywhere from there, anywhere between, say, timeout, delete. All right. My computer's doing a lot of work here. All right, let's go T plus, well, let's just say anywhere between 12.1 and 12:31. So in December, it's going to end up sometime in December. It'll be in between those dates. How about that? Okay. Now let's again use all the coverage strategies. Boom. Let's hit go and let it walk through all this. And it still might come up with a butterfly located there, but here it's finding a debit spread that's well priced, that given that range of targets. Now, it's assuming your target's going to come to pass. And that's the key in understanding this. Trade Finder will assume your target's going to come to pass and say, you know what? If your target comes to pass, all right, here's the best trade you can put on that on average is going to make the most amount of money. Now, expected return will give us, on average, the most amount of money. While it's crunching this, look over here. There's something called ratio of expected return to standard deviation. So remember we talked about having a high expected return and then having the standard deviation be low, because then over the course of your target, there's going to be some trades that might lose, some that might win, but all in all, you want a low standard deviation. So I'm going to select this, and we're going to rank these by those that have a high expected return and a lower standard deviation. Okay, those that have an expected return and a low expected return and a high standard deviation aren't going to really make it. So we want to have a good ratio here. All right, so here we go. Here's the standard deviation. Here's the expected return. This thing found from that spread, a vertical credit spread. Out of all these strategies, it zeroed in on your target and said, okay, so let's go and look at Analyze. Okay. And there's your target, to occur over the width of those dates. So if your target comes to pass, okay, this would be the trade that has the highest expected return relative to the standard deviation. Now, let's go and look at another. Let's rank these by expected return. Is this going to give us the same thing? No, this is going to give us a different trade. So now I'm ranking them by just high expected return. And look at this. Higher expected return, but the standard deviation is much, much higher. So let's take a look at this credit spread.
Autofilled.
And I can now compare the two like this. Let's superimpose. So the high expected return is in purple. The more safer one is in green. So let's now superimpose. And there you go. You can see that the green one has over the width. Here, let me zoom in a little bit so we can kind of see a bit more. Boom, boom, boom. There we go. And let's go to the right if I could. Okay. So you can see then the green is a much flatter set of results. Yet if the target comes to pass, you have this big slanted line here, these sets of slanted lines. And yeah, the average expected return is going to be higher than the green, but the green gives you a flatter range, a flatter look to it. Okay, but again, targeting is everything. And so we can change this target to even encompass a stop loss area where, you know what, if this thing doesn't go to 45 and it instead goes to maybe, 39, oops, you know, maybe we could expand the target out that way. So let's try that, shall we? Let's go to, let's close this. I'm going to go to Trade Finder. Oh, I'm already in Trade Finder. Let's go to Targets. Excuse me. Let's go to Targets. And now let's say this thing might go to 39. And we don't want that. But if it does, we don't want to lose too much money. Or it could go to 47. And we think that this could all happen. It might drop to 39 sometime in the next 30 days. And then out to this. So I'm going to make a very wide range of dates, a wide range of prices. Okay? Now this will change things. Let's just see what happens. I'm going to hit go. This thing is... Yeah, now it's a little bit slower, chugging through, because the target is much more complex. And while it's doing that, let me explain the expected return. Now, we have a range of dates that are pretty wide. It's going to take 3 time frames, each with 11 outcomes, so a total of 33 possible outcomes over this range. It's going to take September 20th, December 31st, and then a point in between those. 11 data points for each of those time frames. Average them together, you'll then get the expected return from those 33 data points. And then the standard deviation will be as of those 33 data points. Okay? All right, what do we got here? Yeah, see, now we're going to have some worst-case returns that are now negative, because we have it going down to 39, and it's going to come up with some spreads that make money if it goes up. But, yeah, if it drops to 39, it's going to lose. That's the worst-case return out of the 3 data points that we have. So we'll see what it comes up with here. Yeah, and the other thing, too, it does slug through every outcome. It masses together all the possible spreads, walks through them all, calculates the expected return, standard deviations, etc. If you work with other backtesting programs, some of them have artificial intelligence where it'll take a sampling of a set of outcomes and then move onward. And this one, much like TradeStation with the systems testing, this is, slugging through every possible outcome. And it takes time. Yeah, long strangles, don't think so. Here we go. Let's go take a look. Vertical debit spread. Let's click on that one, hit Analyze. And let me back this up. There it is. So now the target is going down to 39, going all the way up to 47. And this trade has us getting the highest expected return. Let's now go to the ratio of expected return to standard deviation. And we can see now an expected return of 416 divided by 365. The other one had, come on, click. It's recalculating. 495 divided by 644. So let's go back to the other one. All right, let's look at this trade now and analyze. There it is. And we can go back and forth. There we go. And then superimpose. And again, we see that the red line is the more safe one with the lower standard deviation of returns. The blue line is where you're going for it, trying to get a higher expected return. And presumably, the red line would be the better trade, given the standard deviation function built into that result screen. Okay? But I think you can see, it's coming up with a trade that makes, if you're truly serious about that target, it's going to come up with stuff that is pretty good. And honestly, sometimes it comes up with some trades that you never would contemplate yourself just by throwing it in the matrix, hitting analyze, and, I'll try out this debit spread, that credit spread, and, let me give this out-of-the-money butterfly a try, and off you go, when this thing is really crunching through all of that and factoring all of it into one calculation here. Okay. All right, any other symbols? Just wanted to alert you guys to this feature. Now, it is predicated on good data in the matrix. If it finds that there's a mispriced option, it's going to tee off and go after that mispriced option or that questionably priced option. It's going to zero in on it and say, hey, look at this undervalued call. Well, it's going to then anchor tons of spreads, as many as, on that undervalued call option. Okay, and so you got to, if you're dealing with thinly traded options where there's some bid and asks that are there and it hasn't had any volume, you got to be aware of that when you get in. So, ideally you're working with assets that have well-traded options and the market prices are valid and there's no, squirrely market prices in the matrix. Anyone else have another symbol with a target? If not, go ahead. Sure. Yeah.
Well, the euro US dollar is right around 118, but I think it's going to be a little higher, 120, 121 in the next 30 days.
Okay, so help me out with what do you want a symbol to reflect there in OptionVue, if I could?
You could use the 6E futures contract.
Help me out there, Tom. What do I let's see?
6E. Let's see, what else do I have in my matrix for that? Try U7 space U7. 6E space U7.
Okay.
Yep.
All right.
That'll do.
So that trade
takes the euro. He multiplies by 100, but that's actually $1.1832.
Okay. All right. So here's the matrix. We have the weekly SEP going on out using data from
a month. Go to 121.
Okay, in a month, so T plus 30, you think it's going to go to
22 is about right.
Okay, so let's go to Trade Finder, Assets, 360 Targets. You think it's going to go to 121?
Yeah. Mm-hmm.
And by what date?
That was the
30th.
22nd. It says September 22nd.
Okay,
There
computer
were
catching up.
options for that.
Yep. And then strategies. Let's go to select all covered. Goals.
So all covered just means defined risk trades.
Yes. Yep. There's no naked options. Yep. Goals, 2,000. I'll leave the filters alone for now. Let's see what we get. Now, again, that's a pretty defined trade, one data point in the future as of one date.
Right.
So, again, I would expect that when it gets to butterflies, it's going to go crazy. I could be wrong, but typically that's what you'll see. Here, I'll just write by expected returns. Is this a big matrix?
There's a lot of strikes.
Yeah. Oh, well, it's going out farther in time, too. And that's the thing. You know, it's going out to all the months down in the future, all the expiries after September 22nd, it's including.
Yeah, because they still have open options then, right?
Yep. So it's going to, now you can come to filters here. Let me see if it'll allow me to go to the filter screen in the middle of it. In the first filters tab, you can have it contemplate only options, you know, before a certain date or after a certain date. So, well, so far it likes just calls, really cheap calls.
Sure does, doesn't it?
Yep.
Oh.
Yeah, I mean, and this is the thing. When you, and this is why it's taking longer. It's just simply crunching through more strikes. So here we go to the butterflies. This will be interesting. Let's see if it, and it depends where you're, you know, if there's an expiration right then the butterflies pop way up and it'll just zip in and have a butterfly expiring right on that price that you gave it. Now, but if it's in between, if the date you give is in between, then it'll be a smoother curve. Yeah. It definitely likes the long options.
Sure does.
Mary, well, at 2 cents.
Yeah.
You know, at 2 cents, it's going to, you know, again, you gave it's going to find those that are going to theoretically work out the best right then. Let's see, can I, yeah, it's not letting me analyze yet. Eventually through it, it'll let you highlight and then analyze even though it's crunching.
Sure is working hard, isn't it?
Well, it's going to crunch through every, but look at that, $1 million.
Right.
I mean, theoretically, if it hits that,
trade.
Yeah. But it makes sense though. It makes sense because you picked one price as of one date in the future, and it'll find that call option or those call options that will, for that money, make you the most, assuming it hits that level.
Right.
And that's why, you know, more realistic targets would include a range of prices to occur over a range of dates. Long strangles. All right.
You can probably have it stop if it'll let you.
I could just have it stop. And let's go to this long option here at 2 cents. Okay. Yeah. So that's it. There it is.
Put it on.
I mean, yeah, exactly. Right. So, I mean, do you want to alter the target at all, or?
No, that's fine. Susan asked about a RUT target of 1340, so maybe we could do that.
Yeah, let's go do that. Let's go find the RUT. Unable to find background. That doesn't make sense. Here, let's. All right. So, no, we don't want this. so I got the weeklies in here. 1340 in the next 2 weeks. Okay, so if we go to, now another thing you can do while we're at it, let me bring up the price chart, 1340 in the next 2 weeks. If you bring up a price chart in OptionVue, you can click on this little red item here, Enable Target, and it's going to bring up a blue box, and you can drag this blue box around. Now, 1340 takes it down only just underneath the 1350 right there in the next 2 weeks. So if you think it's going to hit, so in the next 2 weeks, you can drag this box around like this, and you can see up here the price range and the date range, all right there. And you can drag the box around to where you think price is going to hit. Here we got 1332 to 1339, okay? And so I'm just going to go with that for now. I mean, if I put a range of dates, ideally I would have a range of prices, and I can have, I can drag this over a little bit here, and then over the next 2 weeks. Is that going to, I need to really drag that on out, right? If I can. Here, let me pull this one further out in time, right to there. All right, let's just bring it down to there. So I hope that's okay. I'll just use that as our target because that's giving us 1321 to 1342. Let me bring that up a squeeze right there. 1332 to 1342 between the 24th and the 8th. Okay, is that good enough? Let's just go with that. We'll go to Trade Finder. I'm going to go to Assets, bring in, time out. I'm going to clear. Oops, over here. Okay, bring in the Russell. Let's go to Targets. It automatically imported the target range. And I could adjust this if we want right here, but I'll leave it where the box was. Let's just use all the coverage strategies. Now, it's going to crunch through. Should we limit, Susan, should we limit these? Do you have favorite strategies? Because it's, maybe we don't need to contemplate long straddles or strangles, because I assume we're premium sellers around here. Like callers, we don't need. Mary puts. Okay. All right. Let's just go with. We don't need to short the underlying. Okay. So let's just back out of these. We don't need to contemplate this one. All right. Here we go. Fly types. All right. You want to just look at flies. Let me deselect all and look at butterflies. Short butterfly, long butterflies. Let's look at iron condors. Okay. Let's look at, let's look at a few diagonals. Let's look at the diagonals. How about that? All right, let's hit go. Goals, 2000. We're good to go. Boom, boom. Here we go. It's absorbing the matrix first. It's going, oh my gosh. There's a lot there.
So, Steve, does the Trade Finder run locally? Is it OptionVue downloading all the data it needs and running on your computer? Is this all done on the server?
Yep, it's using your computer. It is not using a server. So it's just bringing in the prices into the matrix. Now here it's backtrader, so it's simply locked in there, and what you can have is real-time data flowing in, and then you hit repeat continuously. And so when it does come across a pricing anomaly that's advantageous, you can use that. Make sure you can ensure that using filters in terms of limiting the spreads between bid and ask. You can have the thing actually run continuously and alert you when it finds an expected return over a certain level. And so you can have real-time data flowing in, and it's continuously cycling through some strategies looking for advantageous spreads like that. And when it pops expected return over a certain level, bing, you get an alert, and you go and look, and there it is. Now, you're crunching some data continuously, and it's working pretty hard. So...
And you can only have one instance of Trade Finder running at a time, I assume?
Yes. Yep. All right, well, look at this. For $2,000 expected return. Wow. Well, we did take quite the bearish look here. So it makes sense that if our very bearish target comes to pass, it's going to zero in on trades that are, again, remember, it assumes your target comes to pass. So when you look at these high expected returns, you're going, well, that's just too good to be true. Well, no, it's not. Again, it's assuming your bearish target is going to come to pass, and it's going to tee off on that target. So let me just hit, let me just hit, we looked at, let me see. Yeah, we haven't gotten to the butterflies, I don't think yet. I don't think so. Let's let it crunch through this. Yeah, when you go to diagonals now, it has a lot more stuff to do. But let's just, and it's going to come up with stuff that's higher than this, I imagine, when it gets to butters. So let me just do this. I'm going to hit stop. Okay. And let's click on this and hit, wait a minute, timeout. Should have let me hit analyze. There we go. Let's hit analyze. Well, this is interesting. Look at that. It shows a bullish strategy that still makes money way out here on the downside. That's just crazy. Look at that. Wow. In the Russell, it's modeling. Well, let's just, is that right? Let's send that to the matrix. We're in November, 1440, 1450 call. We're out here in November. Wow. That is just something. Okay. Where is this?
I like using those little arrows to the right.
Yeah, where's our short strike? That's what I'm. Where was our short strike here? SEP. Okay.
SEP, no.
Yeah, SEP. Boy, it found this crazy.
Oh, you see that arrow on the right of your cursor? Those two arrows. You just click on those; they'll take you right to it. Should.
Oh, there's the short.
Yep.
Oh, well, look at that. Really?
$10. Ooh.
Right? And so this is great that we ran this, because this is showing you if there's a bad price in the matrix, and this is where people, get on my high horse here. This is where people get very discouraged. When you have goofy pricing in the matrix and you're on Trade Finder, it's just going to take that and tee off on it. Someone put in an ask of $10, hoping that someone would just put in a market order on that, right? So we have to remove that. I mean, there's nothing else to do except remove that, come back to Trade Finder, and run it again, because that's just going to screw everything up. So it's going to look at all these 1550 calls in SEP that it teed off on. You see that? Because at $10, of course, it's going to tee off on that. So, and here it came back, and I don't know how to get rid of that. It's constantly coming back. So let me go here, and let me just see if we can get rid of it.
Can you go like Control T and put in a theoretical price?
Well, that's a good idea. Let me just put, there we go. Let's see if it will override that. I hope not still. All You know what I'm going to do, though, is here I'm going to stop it and just go look at certain. We're just using too many spreads here. So let's go back to strategies. Let's go deselect, and let's only go to the butterflies that Susan was interested in. Okay?
That should speed it up.
That should speed it up. Let's just look at those. So it initially takes in the whole matrix, and then after that, it'll start crunching it.
So it'll take in whatever matrix you've got defined.
And the
open.
prices, yep. Now I just hope there were no other poorly priced options. That's the thing.
So I guess if you wanted to speed it up, you can make sure you didn't have like leaps or really long-term things.
Exactly. Okay, so this is a more realistic set of outcomes here. You know, for $2,000, it's coming up with an expected return of over 100%. You have a standard deviation kind of high. So let's go to the more conservative approach, where we have an expected return of around 35, 40%. Standard deviation much lower. So that's good. And this is just a
standard deviation of the expected return.
This is a standard deviation of those 11 outcomes. Well, in this case, there's 33 possible outcomes over the course of the price range. The date range. And so this is basically the standard deviation of those possible outcomes in the future.
Gotcha.
So here we have a high expected return, lower standard deviation. That's good. But again, it's teeing off on the target, and the target's quite bearish and quite narrow, too. Okay. I'm going to hit stop. Let's just go here, analyze. And there it is. It shows a very wide butterfly located way out there. So let's send it to the matrix. This is a 1210, 1290 in the SEP. Way out here in SEP in the puts. There it is. The 121 out in SEP. When you analyze it, there's the little target. But that's what it came up with, assuming the target comes to pass. Now, when I create targets, I kind of like it to include an area that would be my stop loss, that if price ended up going the wrong way, then I'm going to include that in my range. And then if I'm really correct, I would flare it out a little bit more, something like that, and that would give me a more realistic trade to do, given that the market could completely go the wrong way on me, right? So that's just kind of what you want to keep in mind.
So would you use that by targeting? So say maybe like a 1365, 1370
well,
target?
Exactly. So let's say if it went up to 1365 down to 1320. So let's go to Trade Finder. Let's go to Targets. There we go. And the low price, what did I say? 1320, 1365 to occur between those dates. And let's just get rid of short butterflies. Let's only look at butterflies then for $2,000. And you're right, I could have whittled out the distant months out there, maybe got rid of leaps. And then it won't contemplate those leaps.
Right.
You know. And a lot of times people put in large on the in and out of the money extents on their matrix, just their their go-to,
Right.
the width of the matrices. So here it's crunching through a whole bunch of 1, 2, 1s, just single butters. And it's wobbling between the weekly and the SEP weekly 4 and the actual SEP price. Let's see what else it has down here. Anything else? Nope, it's the weekly 2s. Yep. And this is where it really becomes super valuable. Here you're seeing the top 50 are really contemplating 3 different expiries. Butterflies and 3 different expiries are kind of all in the running here. And one would be hard pressed to have the expertise themselves to go in and pick out the correct butter that has the highest ratio of expected return to standard deviation. It's just maybe, one has an intuitive sense, but boy, it'd be a lot easier just to let the computer crunch it. Okay, so for Susan, let's let this go all the way to the end. And as an aside, TradeFinder can take your current position and then contemplate adjustments to it to make it delta neutral. There is that feature in here. And I don't know, maybe in a future presentation with you, we could go crunch through that a little bit. But
Sure.
That is a feature in TradeFinder. So if you have a out-of-the-money put butterfly on, a broken wing put, and the market moves one direction or the other, then you want to put on a vertical debit or credit and flare it out a little bit. It'll crunch through all those possibilities and come up with the one that could make it delta neutral, or at least as close to it. So that's a fun little feature. Okay, so here's one. Expected return, so I'm going to just hit stop. It's crunching through slow. Expected return 505, standard deviation less than that, so that's good. Let's analyze. Now look at that. Yep. So if the market moves against us, we're not going to lose a whole lot relative to what we can make if it goes down more than a standard deviation. So there you go. Let's go back and send it to the matrix, see what that would look like. Let's see. What was it again? It was SEP in the 4s. Okay. Let's see. Where are we? Weekly 2s. No. There it is. Well, wait a minute here. Where am I?
Do you need to go one more to the right?
Oh, wait a minute. Is this in the puts? I screwed it up. It's in the calls. SEP weekly 4s. All right. Where are we here?
I think you need to go one more week to the right.
There it is. All right. Then we're in the calls.
You're just showing puts right now. So.
Yep. There we go.
There
it is. There it is. And it contemplated. You saw it was contemplating SEP, the weekly 4s, and it was down. I think it was contemplating a third expiry. So when we analyzed that big one, there it is. We're going out to expiration here, 32 days, but our target is actually much more complex, only going out to September 8th. So there it is. That's the trade that it picked that has the best ratios of expected to standard deviation. I think that's a spread that, would want to found that just by, playing around with it. Maybe, but this is where TradeFinder can really kick in. But you got to make sure there's good data and that your target is realistic. Those are the 2 lessons for the day, Tom. If you use TradeFinder, make sure the data is good, and make sure your target is something that is realistic that can actually come to pass.
And also, don't have extra option expirations sitting in your matrix that are going to
That's another thing, too, because look at this. I mean, it's crunching way out here, and it was including. It was coming way out. It was actually looking at the jams and the Deeses, putting together spreads way out here, butterflies way out here to see if those would have an advantage. And I would say this, Tom, too, because I've been a fan of yours for a long time with all the different broken wings approaches you use, the Rhino, the Road Trip, what's the other one, Kevlar. And when I contemplate, and I can, there's another lesson maybe in the future, but when I have it contemplate 30 days out, the highest expected returns 30 days out over a width of prices, I could put if I were to have it contemplate a neutral spread 30 days out over the course of a standard deviation centered on today, it is instinctively going out to expirations that are right in the wheelhouse of where all those spreads are. What do you guys do around like 60 to 80 days, 60 to 85, something like that?
That's about right.
And that's where, and for the highest expected returns 30 days in the future, which is what the VIX is figuring, right? It's centered on, the VIX is 30 days. That's where it's instinctively going. It's not going to spreads available, 35 days out or 50 days out. It's going right into that sweet spot. 60 to 85 is where it zeroes in on. That is to get that 30-day out high expected return over the course of a standard deviation, a bell curve, centered at today. So I thought that was encouraging to me to watch because I've played with this a lot using those spreads, and Trade Finder, it kind of gravitates. And so I think you guys are operating right in the heart of the highest expected returns 30 days out.
Well, Dan Harvey, I don't know if you've seen this roundtable. I'll paste it in the chat. But he uses that option risk calculator from Nathan Myers. It's online to analyze his different strategies and come up with high expected returns. And so what you're seeing is actually kind of predictable based on Dan's work with that option risk calculator.
And that's by Nathan Myers. Interesting.
Yeah, it's a good presentation. Basically, it shows Dan's methodology of how he uses that to analyze the expected return of a trade and what he's looking for. That's how he modeled the Weirdor and the Road Trip. And it works great.
Yep. I'll have to check that out. No, it's good stuff. No, you guys you guys do great work. I love those strategies and crunching through them, and it's a good way to make money. I think you guys would just love watching the work you do.
Well, kind of Dan and our philosophy is keep the losses under control. So starting below the market. Markets go up most of the time, so you'll make smaller returns, like in a grinding up market, but you won't be losing. And then when the market has a pullback like we're having now, you're not too stressed out about it. So it's a nice, easy way to trade. So I like it.
Yeah. I kind of liken it to, I was doing a strategy before on hedged bull put spreads, where you sell a bunch of credit spreads out in the puts, and then you do an at-the-money bear put spread to hedge those. Mm-hmm. And then that way, and you do it at a net credit so that no matter how far the market goes up, you're going to make money. Yet if it goes down, you have that nice hedge kicking in. Well, I kind of liken it to in golf, the power fade that, who Dustin Johnson uses that off the tee. He'll hit it down the left side of the fairway and drift it in. And Ben Hogan did the same thing. Jack Nicklaus did the same thing, where they basically intentionally slightly would slice the ball from left to right so they remove all the trouble on one side of the fairway. And they're only contemplating trouble on the other side. And in that way, I like strategies that do that, to where you're really not going to be too concerned with one side if it does move that way. But
well, I almost had to do it that way because I almost always slice. So
Nah. Yeah, the problem is then you start aiming more and more left, and you're slicing it more, and it becomes.
And then you hit one straight, and you're in trouble on the left side. So.
Exactly. Yep.
Oh.
You got to watch that. Well,
Steve, really appreciate you coming on and going through the Trade Finder. Lots of good information. I learned a few things. Hopefully, everybody watching did too. And that video from Dan on the option risk calculator is good to check out. And then if somebody's watching and doesn't have an OptionVue trial, I'll put the link in there in the chat
perfect.
for that.
Yep.
And hopefully you can take a look and kick the tires for a while and see what we all like about it.
Oh, yeah. They can kick the tires on Trade Finder and call the office and talk to your rep, and they'll walk you through it detail by detail on Trade Finder. That's what they do. Absolutely.
All right. Well, Steve, again, thanks for coming on. I'm sure we'll have you on in the next few months whenever you're free. And
perfect.
Always appreciate seeing you. So thanks again.
All right. Love doing it. Thanks so much, Tom.
All right. We'll see you.
Bye.